So in the last video, we were talking a little bit about corporations, and we talked about how a corporation is a separate entity from its owners. And with that, not only separates the corporation from its owners. So, for example, if you are a part owner of a corporation, you own stock, the corporation is going to do a separate tax form. You're not going to put it on yours. Unless you get dividend income, then you would have to report that. There is also no mutual agency between the owners and the corporation. And what that means is that if I own 1,000 shares of Microsoft, that does not entitle me to speak for Microsoft. It doesn't authorize me to speak for their business. I would have to be authorized to do that by its board of directors. What it would entitle me to is dividends. And the ability to vote for the board of directors. One of the big advantages of a corporation is because the law sees it as a separate entity from its owners, is the limited liability it brings. So you could only lose your business investment. So as I said earlier, if you had invested, you bought stock in Acctg, and it went bankrupt, you could only lose your investment. So limited liability is big. Okay. And you also have the right to receive dividends, as I said. Now, there are different types of corporations. There are publicly held corporations. In a publicly held corporation, that just means the stock is available to be purchased by the public. So anybody with the money can buy the stock. So Microsoft, AT&T, Bank of America, those are all publicly held corporations. So anybody could buy the stock. Now, under the rules of GAAP, which is GAAP, that's Generally Accepted Accounting Principles, all publicly held corporations have to use what's called the accrual basis of accounting. And what that means is that they have to recognize revenues when earned and expenses when incurred. Now, we as individuals, we don't use the accrual basis. We use what's called the cash basis, right? The cash basis simply says that we recognize revenues. So we recognize revenues and expenses when cash is exchanged. That's what we do as individuals, right? And that's what, small, like home-based businesses do. Okay? When my wife had a scrapbooking business that she operated out of our house, it was a cash-based business. It was only her. The reason why publicly held corporations have to use the accrual basis is to protect their thousands of investors. What the SEC, who is the top governing agency for accounting in the United States, calls the unsophisticated investor. Okay? So any publicly held corporation has to use the accrual basis of accounting. Now, privately held corporations, like small corporations, and even some large ones like DuPont Chemical, Dell Computer, Burger King, those are all privately held corporations. And, my parents owned an auto parts store, and they owned 100% of the stock. It was still a corporation, but it was small. And since they were privately held, they were not required to follow GAAP, or Generally Accepted Accounting Principles. Now, most companies, privately held corporations, do anyway, because often the bank requires it. If the bank is asking for a financial statement for a loan, for example, they might require it to be under GAAP rules. A lot of small business owners have asked the governing agencies of accounting if there could be a separate GAAP rules or GAAP regulations for small business, and the FASB, who develops GAAP, has said no. And the reason for this is because, again, a large corporation has a lot more resources than a small one. And it's much harder for a small corporation to have to worry about following GAAP. Okay? But that's what a lot of them do. Okay? Simply because if they are looking for outside investors or creditors, they may want that. Okay? So when it comes to governance, as I already said, the SEC, the Securities and Exchange Commission, that was created by Congress in 1934, and its role is to regulate securities, securities exchanges, security sales and purchases in the United States. And since publicly held companies sell stock, they fall under the SEC. And the SEC then determines ultimately what the regulations for accounting will be. And its impact on small business is, again, if a small business is following GAAP, they're going to have to deal with SEC regulations. They're also going to have to deal with it if they decide to invest in securities or whatever the case may be. Now, in response to some things that happened early in the 21st century with Enron and other types of companies like Tyson Chicken and WorldCom and the fraud that went on, Congress created this Public Company Accounting Oversight Board, which falls under the SEC and is really designed to enforce accounting regulations for publicly held companies. For a small business, a privately held business, it's probably unlikely you would ever have to deal with them. But it's good to know, who they are. The FASB, as I mentioned briefly earlier, the FASB is the Financial Accounting Standards Board. They're not a government organization, but they work with the SEC, and they develop GAAP. So their job is to develop the policies and procedures for accounting. Okay? And again, all publicly held corporations have to follow GAAP. So, I like to give Apple Computer as an example because that was a business started by Steve Jobs and Steve Wozniak in Steve Jobs' parents' garage. And eventually they expanded over time, and then they went public, and then they had to follow GAAP. So a lot of companies will follow GAAP anyway. But again, a privately held company like a small business that's privately held doesn't have to, okay? Unless the bank or somebody else requires it. But there are some important GAAP rules that and principles that it makes sense to follow, even if you don't have to, if you're not required to. And one of them is the economic entity concept. In other words, separate economic units should be accounted for separately. Or to put it, in a little bit simpler terms, personal transactions should be kept separate from business transactions. You're not going to know if your business is making a profit or how much that profit is if you're including, groceries, school supplies for your kids, vacations, in your business expenses. You're not going to really know what your true profit is. There's also the revenue recognition principle. Right? This applies to when you recognize revenue, and under the accrual basis, you have to recognize it when it's earned, and how much to record. Now, this may seem like a common sense thing. I mow somebody's lawn and they pay me $50. That's what I record. Okay? It can get more complicated when you're dealing with installment contracts and payments. If you own a construction company, for example, and you are building office buildings over more than 1 year, it can get a little bit complicated. The going concern concept, the going concern concept is important to any business, including a small business, because anybody that's going to invest or lend to you will want to have confidence that your business is going to continue into the foreseeable future, right? 20 to 25 years, for example. If I'm going to give you a loan, if I'm a bank and I'm going to give you a 5-year loan, I want to have confidence you're going to be around for another 5 years, right? In a business sense, that you're going to be able to pay me back. So the going concern concept is important, even from an investing point of view. If I'm going to invest in your business, I'm going to want to get a return. I'm going to want to know you're going to be around for a while. So that's an important one. Okay? And then there's the cost principle to record purchase of assets at actual cost. So for example, if I'm buying a bulldozer for my business and the sticker price is $75,000, but I pay $68,000, that's my actual cost. That's what I'm going to record it for. Okay? All right. So those are some basic GAAP principles. A couple more have to do with the monetary unit, the dollar. And sometimes it's called the monetary unit concept. Other times it's called the stable monetary unit concept. And the idea behind this is that we expect the dollar's value will remain stable. Now we know that there is inflation, but we cannot account for that on our financial statements. We know there's a nominal value of a dollar. A dollar is a dollar. But the real value of the dollar is, what can I buy with it? What's its purchasing power? We can't account for the real value of a dollar on financial statements. We can only report the nominal value. So when we compare one year to the next, for example, we have to assume that the value, the purchasing power of the dollar is stable. Okay? So that's why we probably wouldn't compare 1971 to 2021. We know that inflation has eroded the purchasing power of the dollar. If we wanted to compare now to 50 years ago, we'd probably do it with percentages or something different. Okay? There's the disclosure principle, which simply says that we have to disclose enough information to investors and creditors for them to make informed decisions. So we can't hold things back. We have to disclose enough information for them to make the best decision. And lastly is the materiality concept. Small amounts of money that do not affect decision making do not have to be accounted for perfectly. So small amounts of money that do not affect decision making do not have to be accounted for perfectly. So if I have petty cash, a small amount of cash I keep for ancillary expenses like postage or, hey, go get a pizza for everybody, and I'm off by 32 cents at the end of the month when I reconcile, I'm not going to worry about it too much. I can do what's called an over and short. Okay, that's called the materiality concept. So if it's not going to affect decision making, it doesn't have to be accounted for perfectly. So those are some GAAP principles. We'll talk about more of them, as we go forward, but those are some basic ones. So I thank you again for your attention.